We have a lot of news coming from the dividend investing world over the past week. Three different major companies just released their latest quarter's earnings report. We have Starbucks, stock ticker SBUX. We have Leggett Platt, stock ticker LEG. And then we have 3M Company, stock ticker MMM. And I want to take a look at all three of these companies and their recent earnings reports. So let's go ahead and dig into Starbucks. Now, immediately we can see there's been a huge drop in Starbucks' share price. They are in a free fall, and over the past year, down 35%, and year to date, down 22.47%. And you can see exactly when that earnings report was released, they saw a huge tumble in their share price. Let's go ahead and start digging into this. If we look at their earnings release, we can see Q2 non-GAAP earnings per share came in at 68 cents, which was a miss by around 12 cents, and revenue came in at 8.56 billion, which missed by over 600 million, and was also down 1.8% year over year. So clearly not a good report from the company, and the share price has definitely suffered because of this. And the CEO of Starbucks recently jumped on CNBC to explain why he thought the company had such a poor quarter, and he pointed out three reasons. So I'm going to quickly play this clip.
Jim, it was a very tough quarter. Thank you for having me. There were three reasons for this. First, we saw unexpected pressures on our occasional customers, more intense than we expected, that impacted their visitation. Second, the choppiness of the recovery in China continued with a more intense price war than what we expected. And third, challenges of our business in the Middle East that impacted us not just in the Middle East, but also in other geographies.
So the CEO named three different reasons for the problems over the past quarter. He named occasional customers, choppiness of the recovery in China and the prices there, and protests in the Middle East. Now, what I want to do is I want to actually dig into the numbers a little bit deeper and see if that's actually the case. If we look at these metrics here, you can see we're currently looking at Q2 North America segment results. Now, again, keep in mind, this is only North America. We have to keep in mind that Starbucks does have a large international audience as well, so keep that in mind when looking at these numbers. But let's go ahead and start looking at this. Change in comparable store sales was down 3%. Now, analysts and Wall Street were expecting this to be a positive number this quarter. So this came in at a pretty huge shock. And for reference, if we look at Q2 of 2023, this number was up 12%. So that is a drastic difference year over year. Now, we can also see change in transactions. Now, what is change in transactions? It's essentially telling us how many transactions are happening at the store. This was down 7%. And I believe this is one of the problems that the CEO of Starbucks was talking about with occasional customers. Starbucks obviously does have a very loyal and strong brand and a strong customer base, but there are occasional customers that go to the store, and it looks like those occasional customers are not going to Starbucks quite as much, at least over the last quarter. Now, the one bright spot is there was a change in ticket, and that was positive. And that essentially means that each customer that comes in is spending more money. Again, that's up around 4%. We can also see, just like the company has been planning, store count is increasing. We saw around a 3% increase. But here's one of the problems that the CEO did not mention. Look at the change in operating margin. Last year during this time, it was sitting at 19.1%. But now it's sitting at 18%. So declining same-store sales and declining margins are not a good combination. So that's a pretty rough outlook in Q2 for North America. Now, is the story different when we look at international sales? And the answer is definitely no, and in fact, it looks even bleaker. Change in comparable store sales down 6%, transactions and change in ticket both down 3%. Now, like the company was planning, they have seen a large increase in their store count. This has been a huge goal for the business for the past few years, especially in international markets. But here's the huge red flag. Operating margin 13.3% when last year it was 17%. That is a massive decline. So what exactly is the game plan for Starbucks to get back on track? Well, let's go ahead and jump back over to the CEO and see what he had to say about that.
Jim, I think that if I look at the U.S. occasional customer, they have clearly cut back on visits to us. If you look at the value for money scores we have, they're still strong, but there's no question that the occasional customer is cutting back on visits to us. We have not been able to communicate to them the value that we provide. So what we are doing about it is, it's not business as usual, but there's an action plan we have in place in order to do that, to reach them and to communicate the value that we are providing. What we're doing for that is we are making it attractive for them to come back into the Starbucks app and join it. On the app, what you will see is you will see value that they haven't seen because they've not been part of that environment. There are drops that are going to happen every Monday. There are bundles that we're putting in place that are attractive for them. For example, a beverage and a drink at a certain price. And so What you are seeing there is the effort we're making in order to ensure that our occasional customers get to see the value that we provide.
So according to the CEO, it looks like the goal is to find a way to get the occasional buyers of Starbucks to become loyal members of the company. Again, clearly, we all know Starbucks has a very loyal segment of their customer base. How can they move those occasional customers to more loyal customers? And it sounds like a big focus for them is to get them to use their rewards program. But in my opinion, that doesn't completely solve their problems. Again, look at the declining margins that they saw. 18% compared to 19.1% in the US, and if we scroll down, 13.3% compared to 17% in international markets. Now, if we jump over to my profitability spreadsheet, again, you can download any of my spreadsheets on Ticker Data and also get access to the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com. But if we come up here, let's plug in SBUX and hit enter. You can see all this data will automatically load in. Now, if we come down here, we can see the 10-year average gross profit ratio for Starbucks comes in at about 28.5%. If we look at the gross profit ratio for 2023, there was a slight decline at around 27.37, but it looks like 2024 could potentially be even lower. Now, when we look at revenue versus cost of revenue, the company does look decently healthy. Revenue is clearly increasing year over year, cost of revenue staying in line, and the gross profit ratio really hasn't changed too much. Now, if we look at the revenue growth over the past decade, we can see 10-year revenue CAGR came in at about 9.22% and 5-year revenue CAGR at about 7.8%. That's decent growth for Starbucks, but here is part of the problem. In the recent earnings report, the coffee chain said it expects full-year global revenue growth to be in the low single-digit range, down from the prior forecast of 7% to 10%. So again, it sounds like this year this number is going to be quite a bit lower in the mid-single digits. If we jump over to the stock screener tab, come up here and plug in SBUX and hit enter, the data will load in. And if we come over here and look at the dividend data, we can now see for the first time in a very long time, Starbucks starting dividend yield sitting over 3% at 3.06%. For reference, if we jump back over to Seeking Alpha, click on dividends, click on dividend yield, and scroll down, it looks like they actually haven't had a starting dividend yield of over 3% in the past decade. So this is their highest starting dividend yield in over 10 years. If we look at revenue per share, we can see it has been growing at a pretty healthy rate, but again, keep in mind, revenue is not expected to grow at a high rate this year, but they are still buying back shares, or at least they have been over the past decade. They've gone from 1.5 billion all the way down to around 1.14 billion in 2023. So they have bought back a lot of shares over the past decade. Overall, the earnings per share growth has been pretty solid, and free cash flow per share overall has been growing as well. Now, if we want to look at Starbucks from a valuation perspective, let's do something a little bit different. Let's look at them from a reverse discounted cash flow analysis perspective. Now, the idea behind a reverse discounted cash flow analysis is it can tell us how much free cash flow growth is currently priced into the company. So basically, we're seeing this number here, how much growth is priced in and is it justified? And assuming a 9.5% free cash flow growth rate, we get a reverse DCF price per share of pretty close to the current trading price. If we bump it down just a little bit more, it might be more accurate. So essentially what this is telling us is the market is pricing in 9.4% free cash flow growth into Starbucks stock. So now the question we have to ask ourselves is that number justified? And it sounds like over the next year, it probably won't be that high. But before this recent earnings report, earnings growth projections for this company were quite a bit higher than this actually. So we need to ask ourselves, are the headwinds this company is currently facing a short-term concern, or is it a long-term problem? I think if we look at things from a dividend discount model perspective and assume a dividend growth rate of 6% and a discount rate of 8.5%, we still come to a dividend discount model price per share of around $96.67, and 6% dividend growth should be attainable for the company, especially if the market is pricing in 9.4% free cash flow growth. So complete transparency, like always, Starbucks is a position I own in my personal portfolio. If we come over here and zoom in, we can see I'm now down around 5% on this position, so not by a whole lot. I originally added Starbucks a few years ago when it was actually trading pretty close to the range that it's in now, and I have added just a few shares since the recent earnings report. And the second company we're going to look at is Leggett Platt, stock ticker LEG, and this company is a dividend king. Well, let me actually rephrase that. They were a dividend king. This company just announced a major dividend cut by around 89%. So they're slashing their dividend payment all the way down to around 5 cents per share. And like you may have guessed, the market did not like this news. We can see Year to date, the company is now down nearly 50%. That is a dramatic drop in price for a company that was a dividend king, and really for any company of that matter. Now, this isn't a company I've talked about often on the channel before because it really wasn't one I was very interested in, but when you take a closer look at this company's fundamentals, the red flags were definitely there. First off, let's look at their recent quarter's earnings report. We can see they saw a miss on top and bottom lines. Q1 non-GAAP earnings per share of 23 cents, which was a miss by around 1 cent, and revenue of 1.1 billion, down 9.1% year over year, and was a miss by around 20 million. So why would a company that was a dividend king cut their dividend by 89%? Everyone knows the market wouldn't like this. Well, there's a few different reasons. Obviously, as we'll see in just a moment, the dividend wasn't sustainable, but the company wants to change its capital allocation priorities like they talked about in the recent earnings report. We can see the near-term focus on upholding long-held balance sheet strength and continuing to invest in our business. Now, we need to understand where our dividends paid from. So dividends are paid out of free cash flow, and we can see I've already plugged in Leggett Platt. But here's the problem. Free cash flow is what a company can use to also reinvest back into the business. So if we look at where free cash flow per share was at in 2013, $2.32, and we look at where they were in 2023, $2.81, that's not much growth over a decade of time. And we can see there was a lot of fluctuations during this time period as well. It even got as low as around $1.21. So for a company that's a dividend king, ideally, they want to increase the amount they pay out in dividends every single year. They feel that's the best way they can provide value to shareholders. But if they're not growing their free cash flow per share at a healthy rate during that time period, eventually dividend growth becomes nearly impossible. And in fact, it really starts to hurt the company. When you also take into consideration the company reported negative earnings per share in 2023, a dividend cut became pretty clear. So moving forward for this company, the goals are organic growth. This should be a huge goal for any company. And by that, they simply mean investing in our businesses for future growth. And that's why they had to cut their dividend. If they're going to be able to adequately invest back into the business, they're going to have to cut that dividend payment. They're going to pursue strategic acquisitions, but then they're also looking for shareholder returns, but this is one of the bottom line priorities. And they're looking to do this through dividends and potentially opportunistic share repurchases. And that basically means if their share price drops by a lot, they may consider it wise to buy back shares. And then lastly, we have 3M Company, stock ticker MMM, trading at $98.44. And the market has actually responded pretty positively to this earnings report. If we look at them in the past 5 days, they've actually taken quite a jump up around 7.18%. So if we dig into their earnings report, we can see they saw beats on top and bottom lines. Q1 non-GAAP earnings per share of $2.39 was a beat by 28 cents, so a pretty decent beat. And then adjusted revenue of $7.7 billion, flat year over year, but it was a beat by around 40 million. So again, the market did like this news. Now, here's what's interesting about this. 3M actually secretly announced a dividend cut during this earnings report, and a lot of people are missing that. And let me show you how they did this. If we jump over to their earnings report, the marketing was very clever. They said they're resetting our dividend post-Solventum spinoff. So what exactly does that mean? Well, 3M recently distributed 80.1% of their spinoff's outstanding shares to 3M shareholders. And they're using this spinoff as an opportunity to readjust their dividend, but really what that means is they're slicing that dividend payment. And they didn't give us exact guidance on what this is going to look like, but they said 3M's dividend payout ratio is expected to be approximately 40% of adjusted free cash flow with potential to increase over time. And they also stated the dividend payout will be in line with industrial peers and well above the S&P 500 median. Now, if you've been watching my channel for a while, I've been warning of a dividend cut for 3M for quite some time now. You can see I made a video here about 3 months ago, and I believe I made one before that as well. And I also put an article on Seeking Alpha how a dividend cut was needed for 3M and could likely be imminent, and I was right in the scenario. If we jump over to my stock screener spreadsheet, we'll plug in 3M and hit enter. And again, you'll see this data will automatically load in. Now, the starting yield for this company is high. It's above 6%, and this is also a company that's a dividend king with over 50 consecutive years of dividend payments. But the free cash flow story is very similar to Leggett Platt. Look at this. Gone from $6.09 per share in 2013 to in 2023, $9.14 per share. So it has grown a little bit during this time period, but really not a lot for an entirety of a decade. We can also see the company reported negative earnings per share in 2023. And if we jump over to my dividend breakdown sheet, let's come up here and plug in 3M and hit enter. If we come down here, we can see over the past few years, the free cash flow has barely been covering the dividend payments for this company. The free cash flow payout ratio has been increasing over time, as we can see right here. And as a result, those dividend payments were really starting to slow year over year. The growth was getting lower and lower, and the 5-year dividend CAGR actually came in below 1%. So very, very slow dividend growth. Now, there's other things going on with 3M during this time period that I pointed out in my Seeking Alpha article. They had ongoing lawsuits, high debt levels, slowing free cash flow growth, and a high payout ratio. These were all pretty big red flags for 3M. Now, despite the dividend cut, the market actually seems to be pretty happy with the results. Again, shares are up over 7% in the past 5 days alone, and over the past month, they're actually up a little over 10%. But there you go, there's an analysis on 3 big dividend payers and their recent earnings report. Now, like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.